Dan, what happens Monday with those Mexican tariffs?
Well, it really comes down to what Mexico puts on the table later today. If they put out a proposal that would restrict asylum from 3 countries as a person comes through Mexico and into the United States, they would be able to claim asylum. We could get a deal, but Mexico has been resistant to that in the past. They were resistant to make that deal yesterday, and I think the odds are more than likely that the tariffs are going to go into effect on Monday at 5%, and then we'll continue to negotiate through that process.
And the Republican Party just got to stand by, be okay with it? They don't seem like they like this idea.
Sarah, I think there needs to be a distinction in the media that we see. There clearly is a veto-proof majority in the Senate to overturn an action like that. But there's not a veto-proof majority in the House of Representatives. So you can see the Senate take action, the House take action, the president veto that measure. Then you have to have those veto votes, and it's very unlikely the House is going to get to 281 votes. For Mexico, that means the threat is real, that these tariffs can go into place. That creates a very high-stake negotiation later today.
Hey, Dan, we got Fitch cutting their debt rating on Mexico. You got Moody's putting it on negative outlook. How do these tariffs help Mexico combat the migrant flow?
Well, I don't think they do. I think this is being used as a tool to try and get Mexico to do something on immigration that they've never done before. Carl, we can argue whether that's the right thing or the wrong thing to do, but now the pressure is there. And I really don't believe that it is going to have an immediate effect in stemming some of that. Mexico wants a long-term solution, and a lot of what we're talking about are short-term and medium-range solutions. So this is a headwind for risk assets. Even if the tariffs don't go into effect, Carl, now you have to start saying, do you do this with NATO on defense spending? Is it an effective tool to get other policy changes? And I think that's pretty dangerous with the inverted yield curve.
So, Cole, I know you guys are sort of long-term value investors. Has the trade scares created any opportunities for you?
There's nothing that Dan said that I would disagree with. My only issue is that that's already reflected in stock prices. J.P. Morgan had a chart out this morning showing that we are in the 100th percentile of the price of low-vol stocks relative to value-oriented stocks. The other place to play on the trade fears that's incredibly cheap is cyclically oriented businesses, things that are tied to the economy or trade, autos as an example. So the biggest risk to stock and bond markets the next 2 years is that these trade fears are much talked about now, and in 2 years we wake up with a situation where the economy is incredibly strong that 2-year period, bond markets get pounded, and stocks are frustrated by the higher cost of capital in 2 years. That would be the worst of things, but if you're a cyclically oriented business in the U.S. economy, you're going to be smiling ear to ear while people lose money in certain places of the asset allocation world.
Dan, Strategas had a note this week on a macro level, 30,000 feet. You argue that the president has moved from a tax cut mode and a deregulatory mode to one in which he's looking toward the election, trying to delineate some differences from Democrat challengers. And that's why we're in this tariff new reg mode, right? So you don't see this changing for another year and a half?
No, Carl, let me say, I don't even disagree with the other guests. You know, stocks are going to be able to adjust to this because interest rates are going to go down and the Fed's going to respond to this. But if you look at this poll that came out in Texas, where Biden is beating Trump in Texas, Biden beating Trump in Ohio, those are not just the Michigan, Wisconsin, Pennsylvania states, and that's with a great economy. So they're trying to find a political wedge. These trade issues are there, and in the short run, that creates a risk. Carl, the good outcome could be that the Fed starts lowering interest rates, and then we actually fix these trade deals later this year. Trump goes into 2020 with low interest rates, better certainty, and lower tariffs as a tailwind into winning the election. So the short and medium term are very cloudy. It's more of an economic risk as business confidence and CapEx come down. But clearly, the administration's policy has changed from tax cuts and deregulation to tariff increases and regulating sectors to draw a wedge with Democratic candidates and try and boost his polling numbers.
Carl, can I jump in on the Fed rate cuts? Because we disagree with that. And let me just explain why. Brian Moynihan was on television this week explaining he does not see any Fed rate cuts this year. And that, from what bank CEOs are saying, a local bank here, Washington Federal, was on your guys' show last week saying that as well. why are bank executives so comfortable with this economy and where the Fed is at right now? And Wall Street, the smart people on Wall Street, all believe that we're going to have 2 to 3 Fed rate cuts this year. The spread between that is where money will be made and lost this year in the U.S. stock market.
So your expectation is for no rate cuts then, correct, Cole?
Well, why would bank CEOs see more of the economy than you or I could day to day be thinking that, as where Wall Street is pushing towards a very dovish stance? I would argue that Wall Street wants to be dovish because it allows them to be bullish on stocks. But if the Fed doesn't cut rates, it gives them less ground to be bullish on stocks. And that's, I think, personally, that's what's going on Wall Street right now versus, J.P. Morgan's, Jamie Dimon and Brian Moynihan and smaller banks that are even saying those same things.
Dan, just wanted to switch the topic with you,
Sure.
Find out what you're hearing from sources as to what the administration is doing here with antitrust.
Yeah,
and
absolutely.
investigating the big tech firms, Google, Facebook, Amazon, and Apple.
Yeah, so I think it's important to remember this just didn't pop up yesterday. The administration has been moving on this for 2 years. They started really in August of 2017 when they started to assemble their team at the Federal Trade Commission. There were hearings. There was now a review on whether previous mergers were anti-competitive, and now you're starting to see that plan be put into motion. I think it's important that the Department of Justice will oversee Google, but these are long-winded investigations that are going to take time to resolve. But clearly the multiple contraction on some of these stocks are going to be in place. Sarah, it reminds me a lot of Hillary tweeting about drug pricing in 2015 when a lot of clients were bullish on biotech stocks. It took a while for investors to realize that there is a significant political risk, even if nothing passes. And the way I would explain it is that companies now have to focus on the government investigations rather than growing their business. This is what happened to IBM. This is what happened to Microsoft. Other companies are trying to get out of China and figure out how to move their supply chains rather than growing their business, and that slows down productivity.
Though Google did announce a multi-billion-dollar deal today. Dan, Cole, we'll give you the final word on the tech stocks. So you think they act like drug stocks into the election? Big overhang on valuations?
I think it's like people being worried about fat-free foods in Coca-Cola's business in '96. The truth is Coca-Cola was going to underperform because people are going to use less of their product. It's a long-tailed event, like Dan said. That's the problem for tech. It's long-tailed. It's a contraction of multiples ultimately, and it's going to dent margins in the long run.